Okay. All right. So, you seeing my screen? Show the screen. Are you guys seeing my screen? Yes. I think you should be seeing my screen. So again, thank you. This is Noshi. So we are in the trading game. So we are in the trading game, money game, whatever you call it. And every day we compete with millions of traders. And so we are all trying to make money. So sometimes some traders are trading on the same side, some traders are trading against us. So it's a game, and who wins? Whoever is right, that's the person who wins, right? So we go to the market and we bet. We play game. So it's a game. We should consider it as a game, and we consider that there are certain rules of the game. So if we follow the rules, if we don't know what rules we have, then you just might not play the game. So if I go to the party somewhere and they announce that, okay, let's go, let's play the game. So I need to understand what are the rules of the game. If I don't understand the rule of the game, I can play all day long and I have no clue, and I will end up losing. And even if I end up making winning the game in the party, that was by mistake. I didn't know the rules of the game and I just was playing along. I was either shy and didn't ask, and I just participated in the game, and at the end I won. Or I found out the rules of the game after they played 3 rounds. Then I realized that, oh, this is the rule of the game, because I did not ask in the beginning what is the rule of the game. So it's better that we know the rules of the game in the beginning before the game starts. So in trading, it's better that, or for any profession, that we understand the rules of the game, or understand how this profession is should be handled, just like doctors, engineers, or a carpenter, or even a gardener. If when I started mowing the lawn, I was not mowing the lawn correctly. Even now, I cannot mow the lawn correctly. So the gardener knows how to cut the grass. So, what happened in trading, people don't realize it. They just think that they have few $1,000s and they can open the account, and they will ask for the hot stock tips on the Facebook group, or listen to CNBC, Bloomberg, whatever, or ask friend, and then they start trading. And the broker doesn't care. So if you're a broker, the broker doesn't care. Broker just wants you to know that you are a sane person. You are 18 and above. You have money to open an account, whatever is their requirement, 5,000, 10,000, $25,000, and he can restrict you tightly so that you don't blow up your account and don't get him into trouble. So he has done his job, that you don't overtrade such that if you lose, then he lose bigger. So he controls that, and broker is happy and wants you to overtrade. Keep doing it. Do it 10,000 times a day, so he makes commission. That's all he cares. So, and people don't understand, and they take the money and they open the account. The broker is happy, you're happy, and then start trading, and then don't know the rules of the game, and then start losing money. Then they'll go back, find some more money, and bring it back, and give it to the broker, and then trade. So all this goes on, and life goes on. So it's better that we spend the time to understand the rules of the game, which is understand how the market works. Spend time every day to improve, and then succeed. So it takes time. It takes like 10,000 hours to 20,000 hours to really understand, get some idea. It takes more than 10,000 hours, but at least to get some idea. So today give you some idea of how I trade. This is not everything, just a glimpse, just to give you some idea. So to teach you a little bit, it's a 1 hour session. So remember, 10,000 hours required real life trading hours. So we out of 10,000 hours, this is just 1 hour. So so you understand how much you can learn compared to 10,000 hours, but it just gives you some idea. So today I'll show you the slide on a breakout strategy. So what I do with the breakout, and then what I do with the gap up, gap down, gap down reversal, gap up reversal. I'll talk a little bit about that, and then I do a lot of trend break, so trend line. These are my favorites. So I'll show you the charts of the trend line analysis. There's a in my 9-month coaching program, I teach in detail, but here I'll give you some examples via the stocks charts, and at the end I show you the markets chart. So let's begin. So trading is the hardest way to make easy dollar. So trading is a very tough profession. So if you're a trader, you should pat your back that you have chosen, and it's a hard profession. So, but once we understand, master this profession, then the dollars come easy, or whatever is your currency. So trading is the hardest way to make easy dollars, and we should understand how professionals make money in the stock market. In other words, how the big boys, they make money in the stock market, when they come in, when they get out. And if we can try to follow them, understand what through charts. Either you the professional, the big boy, is telling you what he's doing, so you're sitting next to him, or you get the hint from him, or you are his friend, or you are his client. So he's telling you, or the institution's telling you that they are going to do this, then you make money, or you, if not, then you have a help of charts. So you can make money through by reading the charts, because they are dinosaurs. So consider professionals as the dinosaurs, the big boys. So they are dinosaurs. They can run, but they cannot hide their footprint. So we need to understand, read their footprints. So that's what technical analysis is all about, to understand, to read the footprints of dinosaurs. So there is a technical analysis, there is a fundamental analysis, and then there is something called rational analysis. So I'll explain rational analysis. I'm sure you know technical and fundamental, but just to give you some idea, the fundamental analyst um, is do the fundamental analysis, like what is the sales. They start with the sales, what is the cost of the producing the product, what is the sales growth, etc. So all this, they forecast this, and then they come up with the profit for the company, and then based on the profit, then they have many other variables. It depends on the industry. Different industry have different ratios, and then they predict that this stock is this much worth, and since it's this much worth and it's trading at this price, so it's way below the value, so we should be buying it. So if the stock is worth $40 and right now it's trading at $20, we should be buying it. And then they buy it, and then they hold it. They are big boys. They just buy and hold. They have the power. Maybe they are buying it for the pension fund, or long-term, whatever the objective of the fund is. And then they exit when they think that the stock is overvalued now, so they sell. So they could be, most of the time, so there are some sharp investors and traders. They exit early, and if it's a fundamental analyst, then chances are they are just holding, even though the stock is crashing, and they are holding it, because they don't follow technical analysis, just follow fundamental. They say the stock is $40 and it has not reached the value, and it is crashing from 35. So they just think it's cheap. Now we're gonna buy more because we thought it's cheap at 20, so 35 is cheaper, so they buy more. And they make money, they may lose money, whatever they do. And fundamental, so they require a long-term commitment. So they have a long-term commitment. They buy and then they sell when either they need the money and they need to invest in somewhere else, or the stock has gone to over value level, so then they sell. So they have a long-term commitment, because the stock may take time to reach from 20 to 40, or they can keep revising their estimates that now the stock is worth $60, not $40. So the stock is at 40, now they will hold it at for 60. So fundamental analysis requires, it has is a profession, so you need to go to school, do like MBA, etc., and specialize, or you can do the. So I have done the MBA in finance, and one time I wanted to be fundamental analyst, and I almost became. My friends were joining, and I said, "No, man, it's too much dry." It was kind of dry subject that I have to study the company and all the ratios. I was good. I'm good in math. I love the financial analysis, but when it came to preparing the reports uh, to buy and issue the report, it was not something exciting. So I didn't go that route. So anyway, so technical analysis keeps us disciplined. So technical analysis meant to be to keep us disciplined. So which means is that when the stock is saying that it's going up, we need to know that it's going up. So if we are short, we need to exit. And if it's going down and we are long, then we need to exit. So if you know understand this, then you are a disciplined trader. So if you don't understand, if you don't follow this rule, then you are not a disciplined trader. So technical analysis is meant to keep us disciplined. Entry when the stock or the market is telling us. So, for example, if the market is telling us that it's going down, we should be able to read that the market is going down, and or even before the market is going down, we should be able to detect that there's something is changing in the market. The structure of the market is changing. There are some stocks which are leaders, they are going down, and they may drag the overall market down. There's something is happening. So technical analysis of you can do the technical analysis of the market. You can do the technical analysis of the big boys, big boys of the market like Apple, Baba, Baidu, all these kind of stuff. And then you can come up with your analysis that there's something is wrong with the market, and I better exit. I should cash out. So smart traders, they or investors, they cash out way before the market crashes, and they make money on the way down. So another is a technical analysis can trade in isolation. So for instance, I am a technical guy, so I can trade without watching CNBC or reading the news, because I'm just focusing on the chart. So I can sit on an island or in a jungle or on a river somewhere on the board, in Timbuktu somewhere, and I can trade in isolation. And that's what I do. And when you go overseas in a lot of countries, they don't have CNBC, so I don't turn on the TV if I'm somewhere in some country where they are showing their soap opera in their language. So the TV is not on at all, and I'm not watching CNBC or Bloomberg. So I'm just stock market opens, I look at the chart, and I see monkey do. So that's what I do. So technical analysis are price takers versus price makers. So another difference is that price makers means the fundamental analyst, he is the one who's determining that this is the price of this, should be the price of the stock, $20, $30. And he's the one who comes way too early and buys a bunch of stocks and support the stock at certain price. So he is the price maker, and we are the price taker. So in other words, we are a little behind from the price maker, because we are price taker. So we come second as a technical analyst. We come second, and then we follow. We read the chart, and it looks good, and we see that this stock is really taking off. So there are certain stages of the market, and so we need to, in order to make the most of the money, we need to be in the market when the market is moving. So stock is moving, not when the stock is dead. So when the stock reacts, it tells us that it's reacting, it's moving up. That's where we jump in. So we are the price takers. And technical analysis is supposed to understand the supply and demand. So we need to understand the supply zone and the demand zone. So I'll show you through chart that where is the supply and where is the could be the demand. So this is the demand area and this is the supply area. So the stock is moving up from the demand area, and the stock is moving. It could hit it's approaching the supply zone where the sellers are sitting. So we need to understand where the sellers could be sitting and where they were before. So they may be again now, and we should exit or tighten our stop or take some profit. So understand the supply and demand. Now, the third analysis is a rational analysis. So rational analysis is the combination of technical and fundamental. So if you are if you try, your objective should be to become a rational analyst. So yeah, if you are a rational analyst, you are better than a technical and fundamental analyst. And the reason is that you understand the technical analysis and you understand some part of the fundamental analysis. So you may be reading a report. Some people are very good in understanding and reading the trend of the market, a trend in the industry, which products are, which market is moving, and which stocks should be moving, etc. So they read different reports. So they have the help of a fundamental analysis. So they subscribe to the report. So they read those, and then they put them in the basket, and then they apply the technical analysis on those stocks based on the fundamentals, and then they take the entry. So when you combine the fundamental with technical, then you're applying your rational decision, and then you become you're called rational analysis analyst, and you are better than the technical and fundamental. So you have a higher chance of making money. Otherwise, if you just fundamental, is you have to have a big holding period power to hold the stock. So try to be rational analyst. Now, when I was learning, starting my career in this, I met a few mentors, coach. So one of my coach, his name was Chief. He's now, I think, in 98. If he's somewhere alive, God willing, he must be 98 now. So he told me, he gave me this example of Bruce Lee, that Noshi, I was trying to trade a commodity sometime. I'm trying saying, okay, should I be learning commodity? Should I be learning Forex, or I should be trading stocks, or should I trade options, or should I do spread or iron condor, butterfly, all that uh, complicated things. So he said, calm down, just learn stock trading. So that's your first objective, to learn stock trading, master it, and then you may not even want to do any other thing, because you can make enough money for yourself till you become a big boy. Then you can say, okay, now if I buy, I will move the market. I have so much money that if I buy Apple, the market will move, and then I'm in it. Or if I go and sell, the market will move negatively, so they cannot absorb my position. So till then, if you have not reached that level, then you can just stay in one area and master it. So he gave me this example of Bruce Lee. I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So, so this is a perfect example. Just practice one area and master it, and then you can apply your technical analysis into any instrument you want to trade. The principles work same. By the way, you may have registered through Trade Genie, and you are seeing Financial Market Wizard. So both are my websites. I'm transforming myself into trade. I'm rebranding it into Trade Genie. So Financial Market Wizard is still there, but in future it will be Trade Genie. Anyway, so I just wanted to let you know that if you are confused, it's the same. Okay, so and then the chief also said that master the techniques which produces high and fast return. So I was trying to learn many things. So he said, no, just focus on those chart patterns which make you which are reliable. So he gave me the definition that the stock patterns which are reliable, meaning that once you understand that they are giving you a buy signal, then they are giving you buy signal. It's not they are not changing on you often, so the failure rate is very low, the success rate is high. So that you need to focus on. And then you need to focus on those patterns which occur all the time. So don't look for the pattern which occur once in 1 year, and then you're just waiting for that pattern to occur, and then it won't. So you won't make money. So find the master those patterns which are reliable, which occur often, which have a high potential to make money. So if there is no potential, then you're taking too much risk, because there was no potential. And then even though the risk was less, which I thought, but the risk could become big overnight. Something can happen, and the stock can tumble, and then suddenly the risk becomes big. So I am in a hidden way, I am taking a bigger risk than what I am planning to, what I think I'm taking. So always, if I think that I'm taking $1 risk, actually I'm taking more than $1 risk, because there's a slippage and there's unforeseen circumstances, and the stock can gap down. So I'm always taking more risk than what I think I'm taking. So there should be a potential, a high potential in the trade, because I will not. I need to have some room to exit. I'm not a perfect person that I will exit right at the top or exit right at the bottom. I need some room. So I'm in the middle of the ground. So I need a bigger ground to move around. And so if suppose I'm practicing a motorcycle, I remember when I was practicing learning motorcycle, I didn't practice on the road. I used to go in a cricket ground. And boy, cricket ground, if you know cricket ground, is not, there's no grass, it's all sand. And if you fall, you fall. But I used to practice in the cricket ground so that if I'm falling, I'm not hurting anyone, and I have a higher chance of surviving. So that's what it is. You need a potential of making money. Okay, so this slide is all about my clients, my members, talking about, this is some testimonials, and this is another one. So let's ignore this. Let's pay attention to money making strategies. So some of these are on your slide right now. The breakout strategy, breakout reversal strategy, and opening range breakout strategy. So let me explain. Let me explain the opening range breakout strategy. So this is very important. So it doesn't matter what strategy you're using in trading. Everybody should have at least this strategy, and then you can adopt the other put the other strategies on top of this. So I'm trying to I will explain to you. I've explained before, and I'm explaining, and I have written an article. It goes out if you are all in my database, so you should have received it, and so it explained over there. So in opening range breakout strategy is this. Um, we first of all, we all need to be prepared when we come to the market. We need to be prepared ourselves mentally and physically. We need to be prepared. We should be healthy, fresh. Whatever is your morning chores, you should do it, and then you come, and then you know what the market is doing, what the market is, or you expect to do, what are your stock lists, you trade, so you know you have done some homework. So my homework is, there are 8,100 stocks in the market. So I don't trade all those. I cannot trade 8,100. So I cut down to, right now I have 400 stocks in my basket. So that's all I focus on, 400 stocks. So that's my basket. So I have narrowed my basket based on the certain criteria, like they are highly liquid, they are optionable, they have a good ATR, they move reliably. There is always something going on with them. Most of them, there's something going on. There's some news. They are either going up, the stocks are like horses. They go up, they go this direction, and then they move this direction. So they are those kind of stocks like Apple, Baba, Baidu, Facebook, things like that. So I don't trade Amazon as such, and Google, these high price, so they are not there, but I watch them. So all like Caterpillar, John Deere, Home Depot, Lowe's, things like that, JP Morgan, Goldman Sachs. So these are enough for me. So I put a basket of those 400 stocks. Now, even then, 400 stocks is too much. So, so people say, how you can monitor 400 stocks? So I'm telling you. So on my radar screen in trade session, early morning before even market opens, I sort them based on the net change. So some stocks are moving up, some are moving down. I can see that, and some are dead. So, so I know it also gives me an idea about the overall market bias by looking at the stocks on the big boys stocks. They are moving up or down. It gives me some idea about the market. The futures are moving, and these stocks are green. So I get the idea that the market bias is to the upside. So then, so I know which stocks are moving up and down in pre-market. So I make a separate list. That's another issue. So on a 400 stock, when the market opens, then I say, okay, the market opens. Now everybody is moving up and down. So which one to look at? So I put a filter for 5 minute filter. So 5 minute filter means I put a high of a 5 minute, so or a low of 5 minute, depending on what side I'm looking at. So let's just take example of on the looking at the high side. So I say, okay, I want to look at all the stock which are moving up today because my bias is to the upside. So, but I don't want to look all the stocks. Only give me those stocks which are making a new high for the day after 5 minutes. So I put the filter there, and then so the window is blank. So the window is blank in the morning. Nothing shows up. So while the nothing is being shown in that window, I'm taking care of my open positions and watching the market and other things. And then so I'm settling down after the initial burst. So after 5 minutes, some stocks show up. So let's say the 10 is out of 400, the market is really bullish. Out of 410 stocks showing up that they are going up in a 5 minute window. So I say, okay, yeah, these are the stocks. So 10. So I just notice it and I remember it. I kind of remember, okay, these are the stocks. And then they disappear, then they come up, they disappear, some because some stocks just move up and then come down. So they are trading below the high of the 5 minute. So this process keeps going. So I know that which stock is consistently staying in the 5 minute above chart. So that's the one I'm interested in. So let's say Apple and Facebook, they are the one which are trading above 5 minutes. So I know, okay, Apple and Facebook, these are the one I need to pay attention. So I put them in another watch list and I say, okay, let me keep an eye on this. And then so I have another window which is a 15-minute window. So if Apple and Facebook, they are still moving after 15 minutes, then they will show up in that 15 minutes. So at least, so I'm watching it and then I say, okay, they made a new high on 15 minutes. So the stock is moving above its 15-minute high. So I know the price, the high price, and I know the low of the day. So I know what trading range they have in 15 minutes. So it gives me an idea that these are the stocks which have a high volume and they are moving above the 15-minute range. And then I have another window which is 30 minutes. So 30 minutes is the final confirmation. But during the 15 minutes, I make my mind that, okay, these are the stocks which I will take entry on a pullback. And then I will take the entry on a 5-minute chart. So so this is an opening range breakout strategy in a little summary. So you can use it, whatever technique you apply. Then you can put your charts on top of it, and then you say, okay, the stock is gapping up or gapping down, or trend line is breaking, trend line is holding, or support is holding, resistance is hitting, whatever is your strategy. So another one is a breakout strategy. So in the breakout strategy, the stock breaks out of some resistance. So it has to break out of the consolidation zone or some resistance zone, some trend line, something happen and the stock just breaks out. And it breaks out and it's moving with the volume. I'll show you some charts example. It may have gapped up and then just breaking out. So this is a breakout strategy. The breakout reversal is that the stock somehow reversed during the day or earlier the day previously yesterday. It has reversed and came down to some support level, and then it it's moving up, and not only moving up but breaking out. It's just taking out the yesterday's high or yesterday's resistance zone, and then just moving with the force to the upside. So this is a breakout reversal strategy. So these three. Next are the so next is the gap stock. So the gap, every day there are stocks which are gapping up. So there are many. The gap means that if the stock has opened 1 cent above the yesterday's close, that's a gap. Technically, that's the definition of gap. But so there are 8,000 stocks. All of them are gapping. So that's not a meaningful gap. So you need to have some criteria of a gap. So for instance, let's say a dollar gap, so or some percentage. So if the stock gaps 1% of its price, then it's considered gap. So whatever is your criteria, but you should have some meaningful criteria for the gap, $1, 1%, whatever. So let's say $1 gap. So if you put, if I put on a 400 stock, if I put the this gap criteria that give me all the stocks which are gapping up $1, so they will show up. So let's say the 5 stocks show up in the gap. So they are not only gapping up, but they are coming in. I can apply my opening range strategy. So they gap up, and because I applied my opening range strategy, so they gap up and they are staying above the 5-minute high. So if the stock, suppose, was trading at $100 and it gapped up to 102, let's say at open, so it's a $2 gap. So it meets my criteria of a gap of $2. And then I apply opening range strategy. So when I apply opening range, it's trading above the 5-minute high. So it's, for instance, let's say it closed at 100 yesterday, and today it opened at 102, and then it went to 150, $102.50 after 5 minutes. So there's a 50 cents range. So it opened at 102 and it's trading at $102.50 during the 5 minute. So my opening range strategy will tell me that this stock gapped up and is trading above the high of 5 minute, which means it should be trading at $102.51 or 55 cents. So I combine my gap with the opening range. So now I have a better idea that not only it gapped up, but is maintaining its gap position. So this is a good way. Or I can put the same, it gapped up $2, and then I say, okay, gapped up $2, and then give me the stock which is moving above a 15-minute opening range. So after 15 minutes, it may be trading at 103. So if it's trading at 103, that's the high. Then I know that, okay, 103 is the high of 15 minutes, and it opened at 102. So that's the low. 102 is the low of the day, and 103 is the high of the 15-minute. And yesterday's close was 100. So I can make my decision knowing these numbers. So, and then I go and look at other factors such as uh, when the gap occurred, whether the gap occurred at the resistance level, because not all gaps can move up. Not all the stocks are moving up on the gap. Some are pulling back. So the reason could be there's no volume, or the gap occurred at overall in the price chart, the gap occurred at the wrong area. So not all gaps will continue. So some are dangerous, some are traps. So we need to avoid. So I filter all those. The gap need to occur at the right area of the chart, and then above resistance level, or if it's a hitting resistance. So I need to take all this into consideration, and then pull the trigger. So that what goes on in the gap up. And the gap up reversal is simply that the stock gap up and hit some resistance, and now it's pulling back sharply. So on a gap up, you go long or you buy calls once you identify the level with the area where you will pull the trigger. So you go long or buy calls, or you put some combination strategy in options which is bullish, like some spread, Or in the gap up reversal, you say, okay, the stock gapped up at this price, and this is the high. So, for instance, if you know that in 15-minute interval, the stock made 103 high, and now it's coming down, and it opened at $102 level, and now it's trading at 101.9. So it's open, it's trading at below its open, and the 15-minute high is 103. So if that's your technique, you can go short as soon as the stock hits below the open of price of the gap. So it could be, your entry could be below 102, and your exit is based on, suppose your exit is above 103, because that was 15-minute. You have a 15-minute rule that I shorted it, and I will cover if it goes above 103, because that's my 15-minute high, and I will cover, let's say, at yesterday's open price, because the gap will be filled, close price, so the gap will be filled. So that's your gap up reversal strategy. You can buy puts or go short or put the spread. Now, the same thing, if you reverse it, it's a gap down. So I like gap down reversal. So I'll explain to you gap down reversal, and I'll explain. I have some charts to show you. So gap down is, again, there are some stocks which are gapping down, and the gapping down occurs more in a bearish market like we had in December, November, December, November. So the stock gaps down, and they gap down. Some stocks are gapping down in the pre-market time, so you can look at those, or some they don't show anything in the pre-market, and suddenly when the regular session open, boom, the stock just gaps down. So if you have a gap down alert, you look at the gap down alert, and then you say, okay, this is the stock I need to look at for the gap down, and where it gap down. So it could be tricky. You have to understand where it's gapping down. Is it in the support level? Is there a support? Is there some trend line? Is the stock moving up after gapping down? What is happening? You have to watch the intraday chart. You can apply the opening range strategy. So all this goes into the gap down analysis. And sometimes the stock just reverse after gapping down during the day. So if you have a way of catching it, you can catch on a gap down reversal. So they gap down and then reverse to the upside. So a lot of money can be made on a gap down reversal. It's a fast move. Usually it's a fast move, and a fast return comes on a gap down reversal. Okay. Oh, I already covered this. Okay. So now I show you some charts. So this is a trend line. I don't have a slide on the trend line. I teach on the trend line, the upward sloping. These are the trend lines are horizontal trend lines. So horizontal support, the horizontal resistance. So the support could be horizontal, or support or resistance could be horizontal. Or the support and resistance could be in the form of a trend line. So the trend lines are, sometimes the trend line is upward sloping, and sometimes the trend lines are downward sloping. So we need to understand what kind of support line. Is it a downward sloping, or is it upward sloping? What kind of resistance line it is? Is it a downward sloping resistance line, or is it upward sloping resistance line? So once we understand that, all these upward sloping, downward sloping, horizontal, and then when we look at the chart, the stock, and then we understand that, okay, this is the support, this is what it's doing, and the stock could be reaching this level because I see this resistance. But it doesn't mean that these blue lines drawn is a line, is a firm level. It's just a line in the sand saying that expect the stock to react at these lines. So then because if you are expecting that the stock will do this, then you're in a kind of in a ready position to take action. So I'll show you some chart of the trend lines, and there are some gaps, so breakout. So it's a combination. So if you look at AMBA is in my basket. So AMBA moves up and down nicely for swing trader. So I'm a swing trader. So I most of the time I'm doing swing trading. So AMBA fell from like 43 3 level to 33 level. So it was a 10-point down move. So I didn't look at the amber here, but I looked at it 2 days ago. And so when I drew the line, I said, oh, okay, so this was the amber bounced off from the upward sloping trend line. So this was the support, because this is the level 30 level where the stock has moved up all the way from 30 to 43. So the stock nicely moved if at the upward trending support line. So if you draw the line here, this was the support, and the stock did that exactly did. So if you miss, suppose this move, then the another entry comes at some moving average. So it could be a 50-day moving average, or 200-day moving average, or 20-day moving average. So if there is a moving average above the trend line, so then look at what the stock is doing once it reaches that moving average. So then moving average act as support. So in this example, it's a 50-day moving average. It's like a giant hand, and it's holding the amber at 36 level. So it nicely bounced off from 36 level also. So if you missed this entry, then this was another entry right here at cross of 30 moving average at 35, 36. And now, so it's kind of breaking out after 3 days of sideways move. So it broke out on Friday, and the chances are high that it's going towards 40, and this is just a minor resistance at 40, 41, and chances are that it's headed towards 44 level, which is another resistance point here. So EMBA is on the watch list. This one is an example of a gap down stock. So gap down reversal. So ATHM. So auto home. Now it's, you see how the stock gap down and reversed. And how do I know it's gap down? Because I know the stock closed right here, and this is the open, and the candle is white color, white hollow. So I know this is a bullish candle. So once I know it's a bullish candle, then I know the open is at the lower than the high. So the open is right here around 73 level, and it just, so what it did, if you look at it closely, it gapped down big from like 83 level, it gapped down to 73, so 10-point gap down. And as soon as it gapped down, it moved few cents down, and then it started to move up. So how are you going to catch this kind of stuff? So the way you can catch is, I'm telling you, and I catch like this, is the stock gap down. So I know which stock gap down because of the system I have. And then it's moving, then I apply opening range strategy. So I say, okay, the stock gap down, and then I need to apply opening range. So the stock gap down and it's trading above the 5-minute high or 15-minute high. So it came on my radar, and I bought some. And there is a service which is related to just stocks trading, and I send the alert to buy ATHM. So this is the way I catch it. And now my stop. So where would be my stop? My stop would be below the open, below the low of the yesterday on Friday. So the low is just 10-20 cents below the open. So it's this is where my stop is. So in case something happens and it crashes, then I know how much I'm going to lose. So I understand. I'm willing to take the loss. If you're not willing to take the loss, you are in the wrong business. So you should take the loss. So traders they don't take the loss. So take quick loss. Don't, if you don't take the loss, then this game this is a game. So you should be willing to take the loss. So if you're not willing to take the loss, don't play this game. So I'm willing to get out tomorrow if suppose it breaks this low. Otherwise, I hold it, and chances are that it will fill the gap and accelerate. So you can watch ATHM. Next one is AVGO. So we traded AVGO in our swing trade puts, and the reason is this. This is what I teach how to catch. So this is one of the patterns here. It showed resistance levels right here. You can see, and then it crashed. So as soon as it crashed, the puts trade got triggered, and the target was 231, and we exited between 231 and 233, and we exited. So it was a good trade. And now, if you look at this, so the stock just comes down, and then the stock goes up. They have no logic, right? So now it gapped down to 200. It crashed to 200-day moving average, and now it's just moving up. And if you look at it, it's bouncing from the upward sloping trend line. So AVGO is long on 9, so send the alert to the stock alert service, and this is what it did. So it's still moving up. So it's going up, and the resistance is between 255 and 266. So I know if it halts over there, I'll take profit. If it blows through this 260 level, then I will hold it. Otherwise, I just unless it crashes on me and I cannot take the profit. AVLR. So AVLR is trading. If this is a wedge, so in this case, I draw the line at the support. So this is a downward sloping trend line to draw the support, and this is an upward sloping trend line to draw the resistance level. So the stock is bouncing nicely, as you can see on this trend line, and then the range is narrowing, and then finally the stock has to do a one-way move, one way or the other. So what it did, it broke to the upside. So when it broke to the upside, that's why it triggered. I did not enter in this trade, but I'm just giving you an example that if you were watching and you said, okay, if it breaks this 50-day moving average right at 32, I'll go long. And it is still long. So there's no exit here. This one, so this one came on 10th, and unfortunately, I did not take any action on it. But I said, okay. So sometime I didn't, you don't take action, but then you say, okay, I know I didn't take any action. Let me see what it does. It should be going up. So look at the volume and how it gapped up above 50-day moving average. So that was a one signal. Actually, it came on my radar on 10th, and at that time the candle was not like this. It gapped up and then it pulled back. So if you look at the intraday chart, you will see it had pulled back. And so at that, when I look at it, it was not this bullish candle. So it was a kind of nose lost in its direction. So I said, okay, I'll take a look at it, and I missed it because I just ignored it during the day, and then finally when I saw, then it already had made this move. And then look at this next day. So what I'm trying to say is the stock, when it gaps up with the volume above the moving average, you need to pay attention to it. There was this news there. And then this is what it did. So I missed here because the candle was not like this. It had gapped up and it pulled back. So I just missed it. And now it's doing this. So a big move. This is an example of a caterpillar. So caterpillar bounced off from the upward sloping trend line, the support, and now it's facing. And then it bounced again at 50-day moving average. Like I said, that most of the stocks, when they break the trend line, then if you missed it, then you look at the moving average. So they will just bounce around at the moving average, and then they break up. So now it's just facing its resistance at 133 at the downward sloping trend line. So if it breaks 133, it's going towards 139. And the 200-day moving average, it can break and just keeps going up. So 133 is, I don't know what it did on 11. So I prepared the chart on 10. So take a look of Caterpillar. CGC, I did not trade CGC, but one of my members in the Facebook pointed out, posted the chart. He went long, so I prepared the chart for you. So CGC gave the bullish entry right here at this is the first bar. So Anytime when you see the stock bouncing off from the support line like this, horizontal support, and then consolidate, and this was a bullish pin bar. So this is another slight clue for you that the stock wants to move up. But let's say you ignored all this, you were not paying attention. Then when the stock is moving up with a high volume and it's crossing not only one moving average but the two moving averages, then it's clear cut giving you the signal that it wants to move up, and it continued going towards 39. So, but I did not. It's just on the Facebook. Cree, I traded this in my stock portfolio. So Cree, again, as an upward sloping trend line, bouncing off nicely, and then it's breaking the 50-day moving average. So everything is lined up for me to just buy this shares. If I'm wrong at below 40. So that's my stop. I would go I would just exit below 40. So I would put my stop here. So I'm playing this game, trading game, and I'm willing to risk certain dollars. And so if I'm willing to take a certain risk, then I know based on my portfolio size, based on my objectives, what objectives I have, based on my profile, what kind of trader I am, what objectives I have, what portfolio size I have, what kind of risk appetite I have, what kind of profit objectives I have. So I put all this together, 2 plus 2, everything makes it 4. And then I say, okay, this is the trade I'm going to take, and this is what I'm going to lose, and the sky is the limit. So when I know that sky is the limit, because we don't know it's 44, do we know is it going to 52, or is it going to 48, or is it going to 100 or 200? We have no idea. Nobody knows where this stock will be in 2 days, 3 days, 10 days, or 1 month from now. No one knows. Only God knows. So, but you know this much, or I know this much, that if the stock breaks 40 level, 39, 40 plus, like 40, 39.50, I better exit. So I know this much. So when I don't know this much, that this is my risk, I don't know what my profit is. I know a lot of profit coming out. I'm drooling here. So if I know that, I know this on the left side. So if I look at this side, I know this 51 is a big resistance. So if the stock has gone to previously 51, and it tumbled from 51 level, which is this is a solid exit entry right here, and it tumbled to like 32 level. So it is at 44. It can go to 51 level again. So nobody is stopping it. If it wants to go, it can go to 51, and then when it goes to 51, it can go to 61, 71, 81, 91. So I better manage my trade properly. That's where the money is. The money, and that's where the loss is. So the loss is known here, the money is right here. So when you put all this, then you just take the trade. So I took the trade. Okay, yeah. So you see this? Mm. So this is what the trade was taking, and this is what is happening. So the sky is the limit. The loss is not the sky. Loss is limited. But the profit is the sky. Cirrus. So I send the trade on Cirrus logic. So based on just simple chart, which I teach, so it was giving me buy signal here on this based on the sideways consolidation. So I said, okay, what is my risk here? The risk is this, that if it breaks this red candle low, I will go, I have to exit. But if it just can keep going up, and ideally it should go at least to 35, which is a good profit for a swing trading. So from 32 to 35, 3-point move. So 3-point move on a $30 stock is like 9-10%. So that's what it did on 10th. So we took the profit on this options. I think we had a February option, and then it broke 35. So now I told you the line is the sand, and line doesn't mean, just gives you an idea that the line is there and the stock will react. So they react. So exactly the stock reacted to the line, but it doesn't mean that the game is over. The game may have begun. because this is the support in May. You see the support level. So the support became resistance, and if the resistance is broken, then the new game has begun. So the new game begun, and the stock just can go up. So it's now at 35.45. This is Electronic Arts, just a chart for you to see. Again, the downward sloping trend line, it bounced back up, and then when it crossed 50-day moving average, this is another entry signal at an 84.85. HC, so HC is HC bounced from the support line, and then it dropped below the trend line, this resistance line. So it broke the resistance line, and then it dropped back below. So what it does, the stock do this kind of thing. They penetrate the resistance line, and then they drop below the resistance line, and then they gather momentum, and then they take off. So let's say on Monday you are watching this, and you say, okay, I'll keep an eye on this and what it does at 52 level. Is it breaking? So if it breaks 52, you can go long, and your stop is 49, below 49, because there's a 50-day moving average which acts as support. So you say, okay, my stop is below 49. So above 52 is my entry, and the stop is below 49. This is Halliburton. So oil stocks were moving. I just prepared chart. I don't have any entry. Again, just to show you, I don't have any position in it. It's a downward sloping trend line, and it bounced off, and now it's facing 50-day moving average. So what it does, I will find out. Hess is another oil stock, so it's doing the same thing at Hell. So if you look at Halliburton and Hess, is almost doing the same thing. Now it's sitting also at the 50-day moving average. HP is headed towards a 50-day. It's bounced off again at the 10-day moving at the support line, downward sloping. So I'm just giving you some examples. This Hwy also bounced off from the support line, and then it crossed the 50-day moving average. So it's sitting there. So it's kind of far from the moving average. So if it comes back to 17 level and then it moves up, then I would be willing to go long on it. So I just put it on my radar. IQ, I have IQ position in IQ. So it bounced off from the trend line, the same chart pattern I'm showing you. And then when I saw this bullish pin bar and the move, there was a lot of activity on IQ. So I said, okay, I'm going to buy some options and sell between at this level, near 22 level. So I'm holding some options here, and I'm willing to sell at 22. So keep an eye on IQ. I have it already. J&J. So this was a trade. We traded calls and puts, many combinations during last month or so, and then so when the stocks crashes and finally it stabilizes, and then the big boys they come and buy. So it crashed from 148 level. So this was a signal right here that it will crash, and it crashed, and it crashed to 122 level. So then the downward move is over. Downward sloping trend line, the downward move is over. Now it's holding its support at 122, and is in uptrend. So the J&J is in uptrend, and it will continue to move up. So I said, okay, if this is an uptrend, so I decided that is an uptrend. That's the first thing I need to decide, whether the stock is in uptrend or downtrend. So that's the first thing. So I said, okay, the stock is in uptrend. So if the stock is in uptrend, I go long. So where is my stop? The stop could be below 125 with a force, or if I'm willing to hold, to see 122 is okay. I will check the 122 level. Otherwise, I am willing to go long and hold it for 138 level. So J&J is doing this. So on 10th of January, it's sitting right here. So it's facing the 200-day moving average. It's resistance, but eventually it's just doing this. Eventually, it will break to the upside. This is Lennar. So Lennar has been bouncing. I don't have any position. It's just bouncing up from the support, as you can see from the trend line and 50-day. So it's a housing stock, and is in the upward trend, and is moving up fast. Now this one, LRCX. So we traded LRCX in swing trade. We made $200 per contract. So it was a quick move. And so it was based on this 50-day moving average crossover. So again, this stock was bouncing off from the trend line, and then when it crossed the 50 days, so I said, okay, we need to go long on a February option and take a quick profit at this area. So this is the target, 150, 149, 150. But even if it if this gap is filled, I'm willing to take the profit. This gap around 148. So cross a 50-day moving average, go long, and then exited at the $200 per contract profit at 145. And the reason I did is because I saw the stock was doing this candle thing when this candle was formed, so it kind of exit signal for a short-term trade. So when I see this kind of candle forming, it's exit for me for the short term because it's a $200 contract profit on a February option. So if I don't take this profit, the $200 will go away. It will become $100. Then it will become $0 profit, and then I may see $100, $200 loss if it goes back. So for me, $200 per contract better than seeing it loss or trying to milk it for another $50 or $100, or I may not see it. So because time is an enemy. Now this trade MNST. So MNST, this is my so this was a gap up trade. So I'm long on MNST. So, and the reason is that this gap occurred at the beginning of the stage. So there are many kinds of gap which I teach. So this is one gap. It occurred at the beginning of the stage, which is at the consolidation level. So you see the stock was consolidating at 48.50, 48.50, just keep going up and down. And this, if you come back all the way to the mid-May, you see the support right here. So exactly bouncing from the support. So the buyers here at 48. So if you know that the 48 is the support and it's consolidating, but you don't know how long it will consolidate. So if you're a big boy fundamentalist, maybe they have a report, they did the analysis, and then they are rational analysts. So they combine the fundamentals with the technical analysis, and then they determine 48 is a good price. So they bought, so they were buying it here. But then there is a news here. So whatever is the news is in this chart, and it's a positive news. So that's one thing. It's a positive news, and the stock gap up. So now again, you can apply the opening range opening range strategy and the gap strategy and combine it, and then you say, okay, I'm willing to go long on this stock, and I expect the stock will continue. If it fills the gap here and comes down to 50, I'm willing to buy more at 50 level. So I'm willing to buy more at 50 level, and I'm willing to go long right here at the gap. So that's what I did. And then what happened? So it went to the 50-day moving average. Like I said, 50-day moving average acts as support and resistance. So it's acting as resistance right now. And then it pulled back. And then this is a bullish formation. So this candle gave another signal, bullish. In fact, I was teaching on this day when this candle was forming. I was teaching my students, and I gave this example. And then, so this was the second entry. So if you didn't enter right here, you should have entered here. So I added more to my position. So that's the way I do. So let's say I buy 10 shares. So give you example, 10 shares, I'll buy another 2 shares. Or if I buy 1,000, I'll buy another 200 shares. So because I'm getting a confirmation that I'm right. So initially when you put the trade, your chances of losing the maximum is money is the time when you are entering the trade, right at that moment. That's the biggest moment you have when you are entering the trade right there. And later the stock tells you itself that you are right. So when you are right, you better better listen to the stock that is telling you that you are right. So when you're right, and then you have the edge, and then you exploit the edge. So So you don't become a hero right at the open, because if you are a hero right at the open, you don't know if the enemy has a bazooka or a knife. So so you just go with little dollars and you say, okay, I'm in it. And especially if you are in a trade and it's your risk is involved, you are feeling the pain. So you see the pain there if you're losing it. And then if the stock is working, you shouldn't be getting excited. I don't get excited if I'm making money. It doesn't. Nobody can tell that I'm making money if somebody comes to my office. So you stay calm, like a poker face, and then you add. So I said, okay, the stock is telling me that this 51 plus is my strong support, and I need to add. But how much to add? I just don't go and jump with all the force. So I just add a little bit, because always I have this, that the stock may trick me and I may lose. So I need to add a little bit more. So I added a little bit more, and then next day it did again its thing, and it crossed, did this. So I added a little more. So now I'm in a nice profit. So I build my profit right here, and then I'll see what it does at 56 level. So the loss is there. I know what I'm going to lose, and the sky is the limit. So nobody knows. It's at 54 right now. It can be at 5400 tomorrow. Do anyone know where the stock will trade? So the point is that you manage the trade. If you're happy with the profit and you see another opportunity, you exit. So you only exit when the stock is telling you to exit, or you have another opportunity to take the trade, or the overall market is telling you to that you need to close your position, or something, some other factors like a family issues or something happen. So there are many other variables. So then you are closing out the position. Otherwise, you are managing the trade. So you manage the trade and see what happens. MU. So we traded MU. Again, the same thing. It's crossing the 50-day moving average. It was active, and now it's still there. 50-day moving average, it's hugging the 50-day moving average and is about to cross. So the next move up cross is would be another bullish signal for MU. Netflix. So Netflix is a blockbuster. It's coming up with the earnings this week. So now I tell you something. So you see, people, we need to know where the swing move has occurred. We don't take this into consideration, and then when we jump, and then we say, oh, it's doing this. So take a look at Netflix. So Netflix made a low at 230 level and is trading at, I think, 330, 340 level. So 337. So it's a 100-point move already, and it's coming up with earning. So imagine if so the big boys bought here somewhere. So let's say they bought here. So they bought at 230, 240, something like that, and it's trading at 337. And then it could run up to 350 before earning. Let's say it's trading at 350. So from 230 to 350, 120-point move up. So they have 120-point move profit, and a lot of millions of shares. So millions of shares they bought. Keep buying, 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 buying. They just, otherwise the stock will not move. They are buying, buying, buying. So it's 350. Now earning announced, and suppose they miss it and it goes down, and you bought just 1 minute before earning. You bought some calls or shares, 350, and you say, okay, it will go to 420. Earlier I had target of 420 I gave, and it hit right here. So let's say at 350, and then it tanked. So if it tanked 30, 40 points, it doesn't mean a thing to them. These guys who bought at 230, 240, 250, they still make millions. They can exit with their Netflix position. Suppose something not good, they don't feel right, and they will exit and they will make millions of dollars. So let's say they have 5 million, 10 million shares, and they bought at 230 and they sell at 330. So 100 point multiply by 10 million shares. So imagine the profit they have, whereas you will lose all your money. So it's very hard to play the earnings on Netflix right now when the stock has already moved 230. So unless you're doing a straddle or a strangle, so it's hard to do one direction trade. So it's at 37 right now. Nike, Nike chart, I show you Nike chart is hitting the resistance level right now, but you have to see this. When the stock is hitting the resistance level, you need to know if it's hitting at the limping fashion, like a lame duck, or is it hitting with the force. So if it's hitting with the force, the chances are that it will break the resistance. So it's like a big wall, and you have a small ball and a big ball. So are you hitting the wall with the? Are you a Genghis Khan brought a big, catapult and you breaking the wall, or you are a little guy and uh, tennis ball, you breaking the wall with the tennis ball. So it makes a difference if you are a Genghis Khan. So if you're a Genghis Khan, you are bringing the force, and you will eventually break the wall. So this is what these two candles were telling. These two candles were unable to break, because just think of these two candles as a tennis ball of the resistance. So it was unable to break, but then somebody came with a big iron ball, and it is trying to break the resistance. So what eventually is do that when you see this, then the chances are that the wall will be broken, and it's like a fort here. So enemy is trying to enter the fort, and they will eventually will be able to enter inside the fort and conquer it. So Netflix is the one. NVDA, so we traded NVDA again. In NVDA is the one where you make $200-300 per contract, cash the move and exit. So NVDA gave the entry on the, so it bounced from the support line, and then it's in upward move. So now we can say that this is an uptrend, and on this candle gave me the signal, and my target was $200 to $300 per contract, because NVDA February, if you buy a February contract or even March 200 contract is a good profit, and then you it pulls back, and then you time your entry, and then you enter again, and then you make another 200. So it's better to make 200 three times or 600 than you make one time maybe 500, and then you lose another time 500. So NVDA we entered and we exited at 149, 150. So the sell target was given between 149, 150. I exited around 149.20, and logged the $200 per contract profit on Friday. Sohu is another chart I'm showing you. So I'm showing you a lot of charts. It's 6:15 in California right now. So 1:15 gone, 1 hour 15 minutes. So I'm showing you some charts. So Sohu is again the support line, trend line support, right? And it's bouncing and it's facing 50-day moving average. So you can keep an eye on Sohu, what it does. SWKS, this one, I'm not sure if I send the alert on my stock alert service, but SWKS is bouncing and is bullish. So it's the resistance is 71.59, and if it crosses, it's going towards 77.78. So once the stock has established the trend, then all you have to do, you identify the trend, and then all you have to do is cash the trend, the entry. Your entry comes into play, but the most important is your exit. So entry is not that important, where the exit is important. So entry is you can just throw a dart and catch it, but where are you exiting? Are you exiting to minimize your loss or maximizing your gain? And how are you managing the trade? That's more important than the entry. So SWKS is moving up. TLRY, we traded TLRY. This one, the blockbuster profit. The options are crazy, so cannot trade options. So I send the alert on my stock service at 80 level. So this is where I captured the chart, and I send the alert at 80 level. So imagine the $20 catch we did. And the target was 100. I actually revised the target to 106, but 100 was the target for this trade. So send the alert and based on just this chart pattern to buy, go long on TLRY at $80. And we exited right here at 100. Pre-market level on Friday, it was up. It was trading at 98 at the pre-market level, and then it came down to 94, 95 as soon as it opened, and then it bounced back up, and all the way it went to 103. But the target given was 100. So we made 20 points in TLRY. So how this trade was done. It's not just one time I bought it. I bought many times. So many lots, small shares, many lots, and build the position, and then exit the positions at the profit. So build the position a little bit, test it, and then go for it. Texan, I'm showing you another chart, is just hitting the resistance. If it breaks 98, it's supposed to go up further. So another example. VLO is another example I'm giving you, the support line, downward support line, and then it's facing the 50-day moving average. So it breaks 50-day or it holds on a pullback, then you can go long. And yeah, so this is the last chart, and then I'll show you the market charts. And if you are not a swing option member, I have an offer for you for $27 for 2 weeks. So if you will receive email tomorrow, if you don't receive email, or you can send me email today, I'll send you the link for $27 offer, or you will receive email from my office, which will have a PayPal link, a special link for you to take the trial for 2 weeks. It's $27 for 2 weeks, and after that it renews at $10 below the published price. So you can go to the website. It's $10 below the published price, which is 157, and you will be able to renew at 147. Otherwise, you just pay 27 for 2 weeks and take the trial. I have a 9-month coaching program. I used to have a 6-month coaching program, but now I have a 9-month. And in order for you to know what the 9-month coaching program is, send me email, and I explain to you, and it takes 90 minutes for me to explain to you about my coaching program. So I have a unique way of teaching you. Sometimes it says 9 months, it can go to 1 year. And as soon as you join, you get the assignment and the homework, and you start working. And the session starts at the end of February, or mid-February. So there are students already involved and enrolled in it. I'm taking more. And if you're interested, send me email, and we talk for 90 minutes. So I will explain. Now I'll show you just the market charts, just prepared, just to give you an idea. The market is so market right now. See, market is very tricky, and it fascinates me. So I have built a model. Nobody has a 100% perfect model in the market, for market, but you can build it. And I would teach my members how to build. They can build their own. So I build a model. It's a complex algorithm, and I'm trying to give you some example, some idea. So if we understand what the market is doing, we have solved our 80% of the market of the trading problem. That's the key. If you know the market, what the market is doing, and then so the major trend. So once with the market, we understand the major trend, and then in the middle, most of the money you can make is in the middle. The most of the money we lose, or the traders lose, is at the top of the market or at the bottom of the market. So that's where the most of the money is lost. And why it's lost? That's the way the universe is made. Somehow the greed, some vibration, something happened in the universe, or in stock market. The greed is maximum when the greed is at the highest level. That's where the market tumbles. So that's the way God has created this, his universe. So when the greed is at the highest level, that's where when the market tumbles. So the experts have a way of understanding, whether through some sentiment reports or indicators or analysis, they have the way of understanding that the greed is at the highest level, and that's where they liquidate the position. The experts, they start liquidating their position at the when our greed is at the highest level. So if you have a way that we take out all the emotion, we shouldn't be involving our emotion in trading. We should be involving the mathematics. So the whole universe is running on mathematics. The whole stock market is running on mathematics. So if we can figure it out through mathematical formula, that this is what the stock market is telling us, that 2 plus 2 cannot be wrong. It's always 4. It's not 5, right? We can play a joke, or we can sarcasm, or or what not, and say 2 plus 2 is 5 or 2 plus 2 is 22 or whatever, but 2 plus 2 is 4. So if 2 plus 2 is 4, and if you can create a model, and which tells you that 2 plus 2 is 4, and this is what the market is telling me, that the market is condition internally is getting weak. And so there are various ways of finding out what is the internal condition, how the internal condition is getting weaker, and the stocks, biggest, let's say for instance, the big boys are getting sold. So you have this model. Let me understand if the big boys, what they are doing, Apple, Baba, Baidu. Okay, so based on that, you created a model, and then it tells you the market is in will tumble, and so you're either liquidating your position or you're at high alert. And then when you get the signal, so the next step is that what you expect is happening. So that's the first step, that you are internally, you're seeing the market is getting weaker, and then it actually happened what you expected. So that's where you exit your position. So the exit came right here. That's where you exited October 3rd. And but the market was weak way before. Market was it's looking at right now, we see that market is an uptrend, but the market was weak way before, and the market tumbled. So now when the market tumbled, it was very volatile. It was crazy market. So you have to be right, and make money on both sides, up and down. But then this is where the market bottom. So now we know the market has bottomed at this level. If you see this Dow Jones, so this is where the market bottom. But then there are some other market which tells you that they're not bottom, they will crash further. So there's a divergence in between different markets. So which market will win? It's another point. But the Dow Jones won, and the market right now is in uptrend. So if you understand that the market is in a short-term uptrend, we can all talk about all the politics and everything, but right now we have to assume that the market is an uptrend. So you need to pay attention to the long side rather than on the short side. And where the market can go, where the next step I see is this is clear right here at 24,200. So this is where the resistance is. And then the next resistance is this 25,000 level. So I know that the next resistance is 25,000 level, and right immediate resistance is 24,200 for Dow Jones. Again, for S&P, the image is sitting right at the immediate resistance. And how I know the resistance? Because this is a support level. So previously it bounced off from 2600 level, see, nicely twice, and went all the way to 2950 right here. So now the support is the resistance. So again, here was a support, it bounced off, so it tested exactly here, but it faked. This was a fake bounce at just 2 days, and then boom, crash. So this was not this all, it's like a bear trap. So now we are facing 2600 as a resistance. If it breaks 2600 resistance, then it can go to 2700. So that's the way you define your path. What you create a map in your mind about the market. So the map I have created right now is that 2600 is the resistance, and then if it crosses, then I'm seeing 2635 is another resistance level, 50-day moving average. If it breaks, then 2700 is the next one, and then this zone is the next one. So what it does next, the market does, we don't know, nobody knows, right? But we know that what market has done and what the market could do. Nasdaq 100. So Nasdaq 100 again is a V-shape move up. So right now it's a bullish, but when it's like this, when somebody is beaten down horribly, all the legs are broken and hands are broken, and then that person goes to hospital, it will take him 1 month to come out of the hospital. So he doesn't come out in a few hours. Whereas if a minor injury, okay, you come out of the emergency room in a few hours. So that's the difference. How much damage has been done in the market? So the damage is for last 3 months, the damage was done huge. So it takes internally, although the market shows like this, that the market is moving up, but internally the damage has been done a lot. So it takes time for the market to build up its strength, the muscles. So you don't just get the muscle right away. You have to go to gym a lot and eat good food and recuperate. So it's the same thing for the market. So right now I know that the market, this is a 50-day moving average is the resistance area, 6,900 is eventual resistance, and but the market is recovering. So market is recovering and this is the resistance area. That's all I need to know now. And Russell is the same thing with Russell. Russell is facing the resistance right here at 1450. So if you look at from all four markets, all four markets are right at the resistance level, but it doesn't mean that the market will crash. It can break the resistance and continue. So only God knows what it will do. All right. So it's almost 6:30, 1.5 hour session. The next session is again 9-month coaching program. If you're interested, send me email and I teach you more. This is not just this. I don't teach just this. In the technical analysis, there's more to being a successful trader than just learning the technical analysis. So I teach more than that. And the next webinar will be on February 3rd. So Sunday, February 3rd, 5 p.m. Pacific. If I hold it before, then I will let you know. You will receive email. And otherwise, I plan to do February 3rd. And then from onward, I plan to teach you every Sunday something new topic. So I'm preparing on it, working on it. And this webinar is being run on a GoToWebinar software. And this very expensive. I paid $3,000 for it, so it's not cheap. $3,000. So and they have some limited functionality. So I'm evaluating other softwares for webinar. I'm testing it. So if I go that route, you will receive invitation to register again on that software. So then you have to register, unless you want me to automatically transfer it. So that's another route. So anyway, so next webinar will be on February 3rd, and I'll see you on February 3rd. Thank you very much for coming. Have a nice day.